Hi, welcome to our presentation for the Financial Markets and Institution course. We are Group L, and today we're conducting a deep dive into the China rural banking crisis of 2024.
This will be our group member list.
This crisis emerged specifically in 2024, targeting a very vulnerable sector of the banking system, small rural banks and rural credit cooperatives. While China is vast, this crisis wasn't evenly distributed. The financial instability was heavily constructed in specific provinces. The primary hotspots were Henan, Anhui, Inner Mongolia, and Liaoning. It is important to understand why this institution matters. These aren't just banks. They play a critical role in the local economy by financing farmers, supporting small businesses, and serving rural households who often lack access to major commercial banks. The crisis was driven by three factors: rising non-performing loans, liquidity shortages, and loss of public confidence. This wasn't just a local issue. It involved high-level stakeholders including the People's Bank of China and the China Banking and Insurance Regulatory Commission, alongside local governments and the depositors themselves. The immediate result of these factors were severe. We saw mass deposit withdrawals as people rushed to take out their money, forcing significant regulatory intervention to prevent a total collapse.
First, the external factors. Many regional banks have poor management and weak control system. Because of this, risks were not properly monitored. Banks also give too many loans to property developers and small business, which are risky sectors. Some banks lend money too aggressively without proper supervision. As a result, the quality of their assets became worse and more loans could not be repaid. Next, the external factors made the problem worse. China's property sector stayed weak for a long time. So many borrowers could not repay their loans. Economic growth slowed down. The people became less confident to spend and invest. At the same time, stricter regulations and the removal of government support exposed hidden problems. Global economic uncertainty and lower export demand also added pressure.
Hi, my name is Siti Narashura. In this section, we'll be diving into the key economic impacts we have observed. While we have seen some positive developments like control inflation, there are also challenges in growth and specific employment sectors that we need to address. First, on GDP growth, as you can see, our economic growth has experienced a slight slowdown, moving from 5.42% in 2023 to 4.98% in 2024. The primary driver behind this trend is a reduction in lending by rural banks. This has led to credit shortage, which in turn have limited both businesses' investment and household spending, ultimately weakening our overall economic growth. Next, inflation. Here we have some significant news. Inflation has dropped dramatically to just 0.22% in 2024, down from 1.97% in 2022. This is direct result of the factors we just discussed. The reduction in lending and spending has caused weaker domestic demand, which has taken the pressure of prices and led to this very low inflation rate. Finally, the unemployment figures. On a national level, the picture is positive. The unemployment rate has slightly improved, decreasing from 4.98% to 4.57%. However, this national average doesn't tell the whole story. Local jobs, particularly in the real estate and small businesses sectors, have been negatively affected. Stress within the rural banking system has limited hiring and in some cases caused layoff in smaller firms.
My name is Tyrell. Next, I will explain the economic impacts of the rural banking crisis, focusing on stock price and international trade. First, look at stock price. The Shanghai Composite Index declined in 2023 falling from about 3,083 at the end of 2022 to around 2,975 by the end of 2023. This period coincided with rising concern over rural bank stability and stress in the real estate sector. The drop reflects lower investor confidence and increased market uncertainty. However, in 2024, the instead recovered to approximately 3,352. This recovery suggests that government support measures and stabilization policy helps to restore confidence and improve overall market sentiment. And now moving to international trade. In 2023, both import and export declined, indicating domestic financial stress and weaker economic activity. Financial instability in the banking sector reduced credit availability, which affected firms' ability to finance trade and production. In 2024, export showed signs of recovery. This is mainly because large exporting firms in China rely more on state-owned banks rather than rural banks, allowing them to resume trade activity despite yearly disruption. Overall, this trend shows that the rural banking crisis had a negative impact on financial market and trade in 2023. But policy intervention and economic recovery helped improve conditions in 2024.
This slide shows the social impact of the issue, and I break it down into three main areas. First, poverty and loss of public confidence. In 2024, many banks froze deposits and even failed, and this really destroyed people's trust in financial system. For vulnerable groups like farmers and retirees, this was especially serious because they lose their life savings. As a result, many households face financial stress and economic hardship, especially in rural areas. Next, public unrest and political tension. Because people could not access their own money, rural protests increased by about 70%. Many people believe the situation involved corruption or poor regulation. When the government tried to control these protests, it actually increased public resentment instead of calming the situation. And finally, income inequality and regional disparity. More than 9,000 bank branches were closed, mainly in less developed regions. This widened the digital divide because not everyone can access online banking. As a result, rural areas lost access to credit, fewer local jobs were available, and regional inequality became even worse.
Okay, my name is Sanjay and I'm going to be explaining on the financial impacts. So this slide explains the impact on financial system, focusing on bank and insurance companies, where rural banks were more affected than larger banks, with higher non-MPL of around 2.8% as above, compared to about 1.3% for larger banks, mainly because they had heavy exposure to real estate and local governments financing vehicles. Many banks also relied on short-term funding, which led to liquidity stress and deposit withdrawals when confidence weakened. Although mergers helped transfer risk to the banks and reduce systemic risk in the short term, this was also considered potential risk in bigger institutions in the long run. At the same time, insurance companies were impacted through their investment in bonds, trust products, real estate, where lower returns and credit impairments reduce profitability and capital resilience. In addition, trust and wealth management products linked to unstable projects weaken investors' confidence and increasing pressure across the financial system. That's all for me. Thank you.
Hi, I'm Chan. Now I will continue with the financial system impact, which focus on credit markets and also systematic risks. First, in the credit markets, the problem in the China rural banking and default by property developer reduced the confidence among investors. Many investors became more careful, which weakened the corporate bond market and made it harder for companies to raising funds. At the same time, banks were less willing to lend to each other, causing the tighter condition in the interbank and wholesale funding market. Although the government provide policy support and liquidity to calm the situation, normal lending activity remain limited. Next, in terms of systematic risks, the crisis show how problems in small rural banks could spread to the wider financial system. Rural banks, larger banks, and other financial institutions were closely connected through lending and share investment, especially in the property sector and local government projects. When rural banks face liquidity problem, this issue quickly affect other banks. Merger help prevent immediate bank failure, but they move the financial stress to larger banks and increase the risk concentration. As a result, even small shocks could spread quickly, making government intervention necessary to maintain the financial stability. That's all from me. I will pass to next person.
Everyone, my name is Ong. Now I'm talking about the government response to China rural banking sector crisis in 2024 to 2025. Instead of using direct bailouts or big money stimulus, the Chinese government chose consolidation. The NFRA did this by merging and restructuring high-risk rural banks to fix weak points in the system. One big action was bank license action. Over 350 licenses were cancelled in 2025 by merging small banks into stronger regional ones. This was much more than in 2024. For provincial reform, a good example is Henan province. They merged 82 small banks into Henan Rural Commercial Bank to make deposits safer and stop the crisis from spreading. The PBOC helped in monetary support by cutting interest rate and reserve requirement to improve liquidity in rural areas, but no direct bailouts were given. In the end, this step stabilized the sector and stopped people from panicking. However, for long-term consideration, bad assets just moved to bigger banks. This might hide problems instead of solving them fully. This shows China prefer fixing structure rather than quick rescue. Thank you. Now I will pass to my next member.
Hello, madam. My name is Navinesh, and to wrap up, let's look at the recovery and lasting impact of the 2024 crisis. To stabilize the system, the NFRA is consolidating fragile rural lenders into larger, more stable regional banks. At the same time, the PBOC has implemented monetary easing to ensure liquidity and successful to prevent mass bank runs. We learned that the small banks can trigger systemic risk if governance is weak and lending is too risky. Crucially, implicit guarantees must be handled with care, as mismanagement quickly erodes the public trust necessary for the stable system. Moving forward, the focus is on a stricter supervision and balancing financial stability with inclusion for rural population. While non-performing loans remain a challenge for the larger banks, restoring depositor confidence is now the priority for the long-term resilience. That's all from me, and I'll be passing on to my next member. Thank you.
In conclusion, this document has scrutinized the China rural banking sector crisis of 2024 by examining its roots, financial mechanics, economic and social impact, and government interventions. The crisis was not a case of single bank going under, but rather a structural issue within China's financial system and overall economic environment. Structural issues in rural bank, the prolonged weakness of the property sector, and large-scale investment in high-risk sectors such as real estate and local government financial vehicle combined to make the entire bank system unstable. The financial mechanic reveals the concentrations of asset portfolio, fragility of liquidity structure, and dependence on short-term fundings, increased systematic risk. High non-performance loan ratios, weak capital buffer, and over-reliance on the interbank market make rural banks vulnerable to shock. Risks then spring through interbank market, credit market, insurers, and regional banks, turning local distress into a national financial concern. The crisis also has economic and social impact. Credit shortness, slow GDP growth, and reduced investor confidence. Socially, the loss of personal saving, declining trust in the banking system, raising public unrest, and increasing income inequality shows that financial instability directly affects social stability and public trust. Government intervention prevents a full banking system collapse. An authority focused on consolidations, structural reforms, and tighter regulations, supported by target minority easily. However, machine institutions may transfer and concentrate risk, leaving long-term vulnerability. To sum up, the China-Russia banking sector crisis of 2024 showed that regulation sector, high relevance and poor oversight can trigger financial disable. Reforms, good government and public confidence are essential for long-term financial stability and increasing economic growth. Thank you, that's all from us.